Hello and welcome to this live edition of Ask the Service Provider. I am your host, Clem Herod, Chief Projection Officer of CLEMCO. This is something that we do on a weekly basis every Friday to help to provide information for independent contractors so that they know how to better live and manage the independent contractor lifestyle. So on Fridays, right now, what we're doing is focusing on the COVID-19, pandemic, quarantining, what we're going through in this country right now and actually around the world. So we're going to focus on things from an accounting perspective and a budgeting perspective, talking about the CARES Act and talking about different things, like I said, to help the independent contractor manage the lifestyle. We're here today with Kyle Fleischel with Murtha & Murtha accounting firm. Kyle joined us last week and he was very insightful with so much information, helping to share that knowledge. Hi, thank you for joining us, Kyle.
Glenn, thanks for having me. Glad to be back.
Yeah, man. I enjoyed our conversation last week. You know, you definitely think of things from a very strategic, knowledgeable A to B to C, achieving things all the way to Z, long-term goals. So I'm very appreciative for your thought process.
All right, thank you.
So, some of the things that we touched on last week was PPP and the payment protection program and some of the things that the independent contractors are dealing with and getting those funds. What have you seen this past week? Any updates from your perspective of what you understand?
Yep, so there are a couple things that were made clear last week. One, when the PPP program first came out and people found out that large companies like Ruth's Chris and Shake Shack and the Los Angeles Lakers were taking these loans, a lot of the small businesses were pretty upset about that. And the SBA really kind of dropped the hammer and put a lot of pressure on these companies to return the loans. And in doing so, they kind of scared a lot of small business owners into thinking that if the SBA determined that the small business owner didn't need that money, that the SBA would also come after that small business owner to repay the loan. One of the certifications that you have to make as a borrower when you're applying for this loan is called a good faith certification, basically expressing and certifying that you as the business owner are requesting this loan in good faith, that you need the loan because of what the SBA called economic uncertainty. So a lot of these small businesses were thinking that the SBA would come after them because what if the SBA determined that their small business didn't need this loan because they didn't have economic uncertainty? And the SBA released guidelines yesterday, or the day before, excuse me, that said if you have a loan less than $2 million, you automatically meet the economic uncertainty good faith requirement. They will not question your business if your loan is less than $2 million. Now, if you got the loan and it's less than $2 million, but you fraudulently got the loan, that's a different story. The SBA is just not going to question whether or not you took the loan without a good faith certification that there was economic uncertainty in your business.
Now,
so that put a lot of small business owners at ease because they were afraid that maybe they didn't need the money right now, but 4 or 5 months down the road, if their pipeline dries up, well, then they would need that money then. But the PPP loan wouldn't be available then, so they took the money now. And the SBA said, no, we're not going to question you on that logic if you took the loan and your loan.
Now, how does that affect the forgiveness process, though?
Does not affect the forgiveness process. You still have to apply for forgiveness. You still have to use the money for qualified expenses like payroll, utilities, rent, and mortgage interest.
Okay. I just wanted to make sure we were clear on that part.
Yep. The second thing that became clear last week was Schedule C filers. So the single member LLCs who use their Schedule C to go get a PPP loan through the bank. As you know, at least 75% of the money has to be used for payroll costs. Well, single member LLCs, don't have traditional payroll that they run through a traditional payroll company. The SBA released guidance buried deep in the Federal Register that says 75% of your PPP loan as a single member LLC is automatically forgiven. It is considered owner compensation. Okay. So to give you an example, if your Schedule C, your net income from your business in 2019 was $12,000, they calculate your PPP loan at $2,500, and 75% of that is automatically forgiven.
Okay. Now, one of the things that I kind of want to touch on, because some people didn't file for, PPP or EIDL, they didn't feel like they qualified or whatever the case. But we do know that if you did want to file for the payment protection loan, you had to apply for the payment protection loan, you had to file your 2019 taxes.
As a single member LLC, yes, because that's the only way they can determine the value of your loan that you're eligible for. If you're a business and you have payroll, different story. You can use your payroll journals and other reports from your payroll company. But if you're a single member LLC that doesn't have traditional payroll, yes, they determine the amount of your loan based on your 2019 tax return. So that does have to be complete before you can get the return, or the loan. And you have until June 30th to apply for a PPP loan.
Okay, so you have until June. Okay, that's good information. So we have until June 30th to apply for the payment protection loan.
Let me rephrase that. You have until June 30th, or the funding runs out again.
Or the funding, right. Disclaimer.
Yeah.
Yeah, the disclaimer. Now, on the other side of that too, one thing that that has changed with everything going on was the traditional date for filing your taxes was April 15th, and they bumped that back, correct?
They did. Everybody gets 90 bonus days to file their tax return. You have until July 15th now.
Okay, so you have until July 15th. Now I know, because a lot of the independent contractors that I work with and that I coach and try to help them from that standpoint, I know a lot of them had been busy years, right? It becomes a cycle where they're constantly busy doing the jobs and they end up filing late, or they end up not paying, or different things like that. And one of the things that happens is they aren't being organized with their receipts or their invoicing and accounts payable, accounts receivable, all of that type of information. So if someone has been taking receipts and just throwing them into a bag or into a box, or an envelope per month, okay, so there is some form of organizational structure where they're separating it out per month. What is the best way to begin to classify those receipts so that they can give them to an accounting firm to get their taxes done?
Great question. For small business owners that can't afford some sort of accounting system, I always recommend getting an accounting system. QuickBooks. There's other ones out there. There's one called FreshBooks. There's one called Xero. There's one called, can't think of it off the top of my head. I can picture it in my mind. Its logo and everything. It's gonna bother me now. But I always recommend getting a Wave Apps. That's what it's called. Wave Apps.
You're going to stay there. You're going to figure it out.
I was going to think of it. So I always recommend getting some sort of accounting software to manage your expenses. The second thing that I always recommend is do not use your personal bank account for your business expenses and business income. Go get an EIN from the IRS for your LLC and go open up a separate business bank account.
And an EIN being a?
It's called an employer identification number. Think of it like a social security number for businesses.
Yeah.
And if you you can apply for an EIN for your business through the IRS. And if you do it online, they'll sign it in 2 minutes. It costs nothing. It's free. So once you have that, you have to have the EIN because banks will not open a bank account for your business without it. That's why you have to have it. Once you have your business bank account set up, you can use your debit card, you can write checks, you can run everything through the business bank account. Save your receipts, put those receipts in your folder, and now you have one account that you have put all of your expenses through, and you've saved all those receipts. And keep those receipts, because if you ever get audited, you need to substantiate those expenses, and the IRS wants receipts. They do not want bank statements. If you get audited, you give the IRS your bank statements, they're going to say, this is great, we still want receipts. So save those receipts.
How long?
3 years.
Okay.
3 years is the statute of limitations. Unless you underreport your income by 25% or more, then the IRS has 7 years to audit you. If you never file a tax return, then there is no statute of limitations. The IRS can go back as far as they want. But if you file a tax return, generally you have 3 years unless you're really filing fraudulent returns. I haven't come across that. So save all those receipts. Now, all those receipts that you filed away into folders are tied to all the expenses that have gone through your bank account. So then I tell clients, just go to your bank statements and classify your expenses based on those bank statements. It's a lot easier to go line by line on every bank statement. And because every expense went through the bank statement and you saved receipts for everything, you know you have a receipt for it saved in that folder. It's just easier than sorting through hundreds of receipts. You know, it's easier to look at one bank statement and determine what expense category that you want to put everything into from the bank statement.
Now, what are some examples of categories so that people can begin to, you don't have to give us all of them because I know there's a lot, but.
There is. No, it's a great question. So the first place to look for kind of examples that the IRS gives you would be the Schedule C that you're going to file. They have about 20 different expenses right there that you can look at. But those are going to be things like advertising, if your business has advertising, car and truck and auto expenses, interest expense, if you have a credit card and you're carrying a balance, or if you have other loans, you're paying interest on them. Insurance, if you got to pay for any type of liability insurance or other types of insurance. Rent, if you rent a location, you're obviously going to have some rent expense. Along with that is going to be utilities. So those are some common examples of office expenses, so pens, paper, anything like that.
So what if you're a barber, right? And you have a booth rental fee? Does that count as rent?
Absolutely.
Okay.
Absolutely. If I have to pay you to use space that you own, that's rent.
Or if you're a personal trainer and you have to pay to use a gym,
that's
right?
Rent.
To train your clients, that is a form of rent.
Absolutely. If you are paying someone else to use space that they own, absolutely, that's rent.
Okay. Yeah. And then I know research and development is, that becomes somewhat of an area that people kind of fudge sometimes.
Research and development, I think it's a little beyond the scope of this conversation. It's a completely different animal.
No, I mean, okay, but I asked because I know a lot of independent contractors, especially ones in my industry of doing conventions and working on live events. They'll take training classes. And they'll take classes in order to enhance their skills to provide a better service. What would that kind of be classified under?
I would call that education and training. I wouldn't call that research and development.
Okay.
Yeah. Research and development is really you investing in a brand new process to enhance your business in the future. So it's more investigative, testing, that type of nature, as opposed to what you just described. I would consider that to be education and training, or if in a lot of professional licensing, it would be considered continuing education.
Okay. And that makes sense. Okay. Thank you for that.
Yeah.
So one of the things that we mentioned last week was talking about LLCs and how an LLC is not a tax classification. Is that correct? Am I saying that correctly?
That's correct. If you go to the IRS and you say, hey, Mr. IRS, I'm an LLC, they're going to say, that's great, we don't recognize LLCs. So they look to the ownership structure of the LLC to determine how you are going to be taxed. So I try to explain it as think of it like two completely separate entities that you would qualify your business as. One would be a taxable entity, one would be a legal entity. So when you form the LLC, you go to your state and you say, I want to be this form of legal entity under the laws of my state. And then when you go to the IRS, you say, okay, I want to be taxed as this entity under rules of the Internal Revenue Code. So it's two completely separate things. And I always like to give the background on how these things came about. You know, way back in the day, you really had three options for your business. You could be a sole proprietor, you could be a partnership, or you could be a corporation. Sole proprietor, just one person in business for themselves. Partnership, you and a buddy in business with each other. And they really operated the same way. They had no liability protection. So if you know, I mess up in my business and I get sued, well, they can sue me for all my business assets and my personal assets, as opposed to a corporation where it acts as a different entity, and it is actually in tax kind of tax articles, and if you read about tax laws and stuff, a corporation is considered a person as separate from its owners. So it can enter into contracts, it can sue and be sued. The downside to the corporation was that it was double taxed. So the corporation made a bunch of money, paid tax on those earnings, distributed those earnings to its owners in the form of dividends. Owners paid tax on those dividends again. So sole proprietor and partnership paid tax once, but had no limited liability. Corporations had liability protection, paid tax twice. So people came out and said, well, we don't like that idea. You know, we want to have the best of both worlds. So the IRS came out, and the IRS said, well, okay, we'll create a new subchapter of the Internal Revenue Code called Subchapter S. You can elect your corporation to be taxed under Subchapter S. So they came out and started S corporations. So now you have an S corporation taxed under Subchapter S and a C corporation taxed under Subchapter C. S corporations were great because they got the liability protection and the profits were only taxed once. Well, fast forward a little ways further, and one of the downsides to a corporation is that you have to distribute profits, in proportion to ownership percentages. So if I own 50% and you own 50% of corporation, I get 50% of the income, you get 50% of the income. I get 50% of the loss, you get 50% of the loss. Well, what happens if, you know, I want to start a business with you and you have all the expertise, you know everything there is to know about AV and HR, you are great with your clients, and you're going to build this perfect business, but you're broke. You don't have any money to start the business.
Right.
So you come to me because I'm rich and I don't know anything. And you say, Kyle, I need to borrow some money, or Kyle, let's go into business together and I'll put up all the money and you're going to come in with the knowledge and the expertise. Well, if the business has a profit, that's great. We split the profit 50-50, but what happens if the business has a loss? You know, you haven't put any money into the business and I've put all the money into the business. Do I get to take all the loss? Do we get to split the loss? How does that work? In a corporation, it's 50-50. Doesn't matter. Or, you know, you own 75, I own 25. It's whatever that percentage is. So states came out with the LLC, which allows you to have the liability protection of a corporation, but you can determine how you want to split profits and losses between owners, multiple owners of an LLC. When the states came out with this legal entity, the IRS said, well, that's great, but we already have rules in place to tax these types of businesses. We're not going to create different rules for LLCs. So they said, we're just going to look to the ownership structure of the LLC, and that's how you'll be taxed for taxation purposes. Long-winded example or explanation.
No, man. No, I mean, no, but you know, and so that's the thing about this show, right? Some people will get it. Some people will dial right in, and some people win right over their heads. But that's the independent contractor, small business owner, you know, difference. There are so many people on various ends of the spectrum, but we all fall under this level of taxation and organizational structure that we have to figure out.
Absolutely. And the different types of taxable entities are beneficial to different types of people. You know, not everybody can qualify to be an SCorp. An SCorp may not be the most advantageous type of structure for you. And you can always start an LLC and elect to be taxed as an SCorp at a later point in time.
Right. So one of the clients that I'm working with is a personal trainer. Okay, that's one of the markets that I'm beginning to work with as well. So just outside of AV, now going into the personal training sector, who these these trainers are falling under a 1099 contractor. Okay. So now in this space, say, you're not, sometimes when you're first starting off, you're not making a lot of money, right? You're trying to find your way and build up your client base. Okay. So now say, we'll just $15,000 was your annual earning as a 1099 contractor. Okay. Do you still need to file your taxes with receiving a 1099 for $15,000? And that's your earnings for the year?
Yes. Yes. The IRS, well, let's back up. If you get a 1099, you can assume that whoever gave you that 1099 told the IRS that's how much money you made as well. Okay. If you don't file a tax return, the IRS will always assume the best case scenario for the IRS. So they'll think you made $15,000 and had no expenses. So let's look at your personal trainer client. If they made $15,000, well, they probably had to pay to rent space in a gym. They probably had to drive a vehicle to get to that gym, unless they live in the gym. And I don't know anybody who does that permanently anyway.
I mean, there's gym rats, but that's
a whole gym rats, but that's a whole different story. So there's definitely going to be some expenses that you want to take against that income. And it is your responsibility as a taxpayer to tell the IRS what those expenses were on a tax return. If you don't, the IRS will assume you had no expenses, and you can expect a letter from them demanding the amount of tax owed based on the full $15,000.
Okay, so now what you're saying is you earned $15,000, you received the 1099. There are expenses that are a part of doing your job. Some of those being rent, some of those being gas, some of those being maybe some equipment that you purchased to help train someone, whatever the case. Those are items that you paid for that can come out of, I believe it's called reducing your taxable income.
You can deduct from that income. Yes.
Right. So if you earn $10,000 and let's say that you spent you spent $2,000 in all those various things that we've kind of mentioned, now you'll be taxed on $13,000 as opposed to $15,000.
Correct. But if you don't tell the IRS that you had those $2,000 of expenses, they're going to tax you on the full 15.
Okay.
They're called business expenses, and you're allowed to deduct anything that is reasonable and necessary for your business. And it's got to meet, but it's reasonable and necessary, not reasonable or necessary. Now,
and that's some of the classification things that we were talking about earlier with the receipts and keeping track of those things.
Exactly. So the example I use is, you probably want to buy some office supplies. You need to buy pens and paper for your business. Is it reasonable to buy pens and paper for your business? Probably. Is it necessary? Yeah, it's necessary to buy those expenses. Now, you got to meet the reasonable test. Is it reasonable to go to Office Depot and spend $5 on some pens? Yes. Is it reasonable to buy $5,000 gold leaf pens? Well, no. You can't deduct that. It's not reasonable.
No, but it looks good for my brand if I have this gold leaf pen, which helps me to build a certain clientele. Yeah. If I have that,
$5,000 pen is debatable if it looks good for your brand or not.
but those are some of the things that people will tell themselves to justify some of their expenses.
Right, and that's great. They can tell themselves that, but the IRS will most likely see it in a different way. Right. And I get a lot of clients who also think that being an SCorp versus a single member LLC allows you to deduct different expenses, or what you can deduct as an S-corp is different than what you can deduct in an LLC, and that's not true. It's reasonable and necessary.
Okay. So there may not be a need to do this extended type of company structure if it's not. Well, first of all, back it up. When do you determine if you move from a single member LLC to, say, an S-corp? Or is that a whole nother show? Should we wait on that?
How much time do you have?
All right, we'll wait on that. We'll go into that on the next week. We'll tap on that into next week.
We'll do a whole nother show on the biggest difference between the two.
Okay, okay, because that is a
Spoiler
big
alert, has to
thing.
do with payroll.
Okay, right. Oh, yes, yes, yes. Yeah, we'll save that for another episode. Um, what penalties should someone expect if they don't file their taxes?
Um, so there's two there's two penalties for failure or not filing your taxes. One is a failure to file penalty, and the other is a failure to pay penalty. All right, so everybody's familiar with the April 15th deadline. You always have to pay your tax by April 15th. There is never an extension. Shouldn't say never because there's an extension this year. But under normal circumstances, you don't get an extension of time to pay your taxes. The amount due is always owed by April 15th. The extension is for an extension of time to file your taxes. So if you file for an extension to file, and you are granted the extension to 6-month extension to file your taxes, you still have to estimate how much tax you're going to owe and make that payment by April 15th. If you don't pay the full amount of tax owed by April 15th, the penalty is 0.5% of the amount owed per month, up to 25%. Do the math, that's a lot of months. If you do not request an extension, or you do not file by the extension date, or you don't file by the due date, then the penalty is 5% of the amount owed per month, up to 25%. So it is literally 10 times worse not to file a tax return than it is to not pay your taxes.
Wow. Okay. Wow. So I think that this is going to be a whole nother topic that we'll discuss one day, and we'll probably get into a whole whiteboard session and all that, so that people can see. No, so people can see the numbers, right? Because you're talking about
Yeah, no,
percentage.
absolutely.
Yeah.
Absolutely. It helps to draw it out and visualize it as well. But real quick, if someone owes $100, okay,
Mm-hmm.
then they don't file the tax return, they're going to pay a $5 penalty. If they file the tax return but don't pay, they're going to pay a 50-cent penalty. So
There's a big difference.
it's a big difference, and that's a
And you're only
small
talking about
example.
$100, right? Exactly. When you're talking about
Yeah,
thousands and
throw some more
10,000.
zeros
Oh,
on the end of that for real world examples.
right, right. Okay.
Mhm.
So,
And I'm sorry, Clem, one more thing that I think I should mention. If you do not owe tax, then there are no penalties. The penalties are only a function of the amount of tax that you owe. If you do not owe tax, if you have a refund and you don't file, there's no penalty whatsoever. The only catch is you have to file a return and you have to request that refund within 3 years of the due date of the return. Otherwise, the statute of limitations expires and you don't get that money back. And we've seen people forego $3,000, $4,000, $5,000 refunds because they waited 4 years to file the tax return.
and I'm gonna tell you something right now. This is the reason why I hired an accountant to do my stuff, to help me with my business, because I personally don't have time to think about all these things and study and do research for all these things. But when you're an independent contractor just starting off, you don't know. You don't know
No.
what you don't know, but what you don't know will get you in trouble.
Yep. I had a client who back in, must have been 2013, 2014, had a very successful business, and he paid, I think he must have paid $20,000 or $25,000 in estimated taxes. So the 2014 return is due in 2015, so you have until 2018 to file the return. Well, he comes in 2018, and I'm going, and he had a big refund that we needed to apply to the next year, and I said, we got to get this done. If you go until after April 15th, the IRS is keeping your $25,000.
Wow.
So it's very, very important to, especially if you do a refund, file tax return.
Yeah. Okay. Now, this will be our last question, because I know we're tight on time here. We're running over, and I know you have work to do. And it's Friday. I mean, it's almost the weekend, baby. Come on. Does the IRS offer payment plans for people to earn or to pay the money that they may owe?
They do. If the amount that you owe is less than $50,000, you can apply for an automatic approval payment plan. You have to pay it off within 6 years. So you get 72 months. There's a couple different ways you can do it. You can file a form with your tax return. Don't ask me what the form number is. I don't remember. 9325 or 9465, something like that. And you can put the amount that you want to pay. You can put your bank information on there. It'll go, it'll transmit with your tax return. It'll take a couple months for the IRS to set it up, and then they'll just start automatically taking the money out of your account. You can also create an account on the IRS website and request and set up a payment plan that way as well. I recommend doing it that way. The setup fee for that is like a one-time $35 fee versus doing it with your tax return or submitting the installment agreement request on paper. The setup fee could be, I think, $150. It's something a lot more than it is if you just set it up online. A couple things to note: if it's over $50,000, you can still apply. You just got to give the IRS some more information. If it's over $100,000, then you got to. It's almost like applying for a bank loan at that point. And you cannot have two installment agreements on file with the IRS. So if you owed a bunch of money last year and you set up a payment plan last year and you owe a bunch of money this year, you have to contact the IRS to consolidate the two amounts owed into one payment plan. If you set a new payment plan up for the current year, they will cancel the one you had for the previous year, and you will start getting letters demanding that in full.
Okay. Now, to simplify some of the process, because it can be overwhelming for people.
It is.
Are these services that you could reach out to a CPA to help get taken care of?
Yes. We can assist with filling out the form and submitting it with your tax return. If you're going to consolidate an installment agreement request into 2 years taxes owed into one agreement, or you want to set a new one up online, typically that's straightforward. Most people can do that on their own at home. And the only reason I really recommend doing that is if I tried to call the IRS and consolidate a payment plan for you, the IRS is going to tell me to go pound sand because I'm not the taxpayer.
Okay.
They don't want to talk to me. They want to talk to the taxpayer.
Right. They want to know why you didn't do what you were supposed to do.
Right. Right. They're just not going to give out any personal information to anybody who isn't the taxpayer.
Okay.
And a lot of people think that we have this back door into the IRS and we can move around and all the information.
That's what I pay you for.
Yeah, right. I wish that was the case, and unfortunately, it's just not the case. We can file a return, prepare a return, but when it comes to actually getting information about the taxpayer that the IRS has on file, we can't just go grab that information. Usually, the taxpayer has to request it because we don't have a power of attorney on file, and the IRS won't release personal information to anyone other than the taxpayer.
Okay. So, Kyle, thank you so much for your time. Thank you for being a part of this initiative that we started with CLEMCO to help the independent contractor learn how to manage the independent contractor lifestyle.
Absolutely. Clem, thanks for having me. Appreciate it.
All right. So, as I previously stated, CLEMCO is a brand, a company that is focused on coaching, leading, educating, and mentoring independent contractors. We're here to provide a service and to make your life more comfortable so that you can run your business, be successful, and be happy doing it. Tune in next week, like, subscribe, click that bell, do all those things necessary to be notified when we are posting new video and new content.